Welcome to the Options Impact video education series. This is Tier 2 outright option positions, Cluster 1 long option positions. And here we'll be discussing, in this video, understanding the long call. I need to point out that options are not for everyone, and you should read characteristics and risks of standardized options before trading. And you can get a copy of that by calling 1-888 Options. That's the home of the Option Clearing Corporation here in Chicago, Illinois. All right, so as I mentioned, this presentation is understanding the long call. Trading a long call is the most basic option strategy that we have, and it is many traders' first foray into trading options. It's reasonably basic and fairly easy to understand. And the most important thing to understand about the long call is that it has limited loss and unlimited profit potential. This is a mantra that all new traders should have ingrained in their trading souls. Long calls have limited loss and unlimited profit potential. A trader can only lose what he or she pays for the call, but the upside potential can be disproportionately high. In fact, theoretically, mathematically, it can be infinite. Now, this feature of options enables a trader to take advantage of leverage. This is a great feature of options and a tremendous benefit to the long call. Now, this benefit does not come without a trade-off. When traders buy an option, they must suffer the fate of time decay. As each day passes, options lose their value little by little. That's referred to as time decay or erosion. Even if the underlying stock doesn't move higher or lower, the option will still decay in value. In fact, in order for the long call to generate a profit, it has to move high enough in order to cover the time decay of the option. A trader would buy a call when he or she is bullish, when he thinks the market is going up. From a directional standpoint, long calls profit when the market moves higher and lose when the market moves lower. Couple that with the time decay feature of options, and we have at least two very important criteria that a trader must concern him or herself with when trading a long call. Because a trader must overcome time decay, a trader would buy a call when the trader expects future volatility, specifically to the upside. The trader wants a big move up in the underlying stock and wants that move to happen quickly. A trader may decide to buy a long call because the trader seeks the leverage benefits of options. A trader may also seek to buy a long call because the trader seeks the limited risk benefit of options. To understand better the risk profile of a long call, let's look at an example. These prices are not current. This is Caterpillar when it was trading at $1.12.81. Imagine that a trader decides to take a bullish position in Caterpillar by trading the long call. So the trader may buy the March 115 calls at $2.75 right here on the offer. Now imagine the trader buys these calls and holds them until the option expires, until March expiration in this example. If at expiration the stock is trading above the strike price of 115, the trader can have unlimited profit potential. If the stock is trading above 115, the trader can exercise the 115 strike call, thus buying the stock at $115 a share. If the stock is trading significantly higher, say $170, the right to buy the stock at $115 can have great value that's easily calculatable. If the stock is trading below $115 at expiration, then the trader would not exercise his or her right to buy the stock at $115 because the trader would be able to buy the stock at a cheaper price in the market. Thus, the $2.75 the trader paid for the calls would expire and the trader would lose $2.75 or $275 of actual cash. Now, what if the stock is above 115 but not much? The trader may or may not have a profit. In this case, the pivot point is $117.75. That's the break even. The break even of a long call is the strike price plus the premium paid for the call. So in this case, it's $115 plus $275 is $117.75. Because the trader can exercise the right to buy at 115, when the trader actually exercises the option, he must consider the $2.75 paid for the call. So effectively, the trader would be buying stock at $117.75. The $115 paid for the stock plus the $2.75 paid for the option. The long call strategy is a bullish strategy. One motivation for using a long call is as a stock substitute. Traders can trade with slightly different perceptions when thinking of the long call as a stock substitute. Some more aggressive traders can consider the leverage feature. Instead of paying $115 a share for Caterpillar, I can control 100 shares by paying $2.75. That's leverage. In fact, for $115, I can buy many, many calls. And I can make a highly leveraged profit if the stock rises, and I can lose quite a bit if the stock falls. Another way traders can consider the long call as a stock substitute is as a hedged position. If instead of paying $115, the trader only pays $2.75, the trader can take the remaining money that is not applied towards risk capital and put it in an interest-bearing, safe account. The trader only risks $2.75 instead of $115, but still has much of the same upside potential. This has been a presentation of Market Taker Mentoring, LLC.